In the tumultuous world of international trade, former President Trump's tariff plan aimed to shield American industries and bring back manufacturing jobs. By imposing tariffs, particularly on China, he hoped to force companies to relocate production to the US. However, the reality proved complex, with unintended global consequences. Instead of bending, countries like Canada and Mexico sought new markets, strengthening ties with China. This essay explores how Trump's tariff plan backfired, reshaping global trade alliances. Canada, America's neighbor to the north, has long been a reliable trading partner. The two countries share the world's longest undefended border and a strong economic relationship. However, Trump's tariffs strained this relationship, forcing Canada to reconsider its reliance on the US market. The energy sector was significantly impacted. Canada, the world's fourth-largest crude oil producer, relied heavily on the US market. With 90% of its oil exports going south, Canada was vulnerable to American pressure. The tariffs prompted Canada to diversify its energy exports. This led Canada to an eager trading partner, China. The Canada-China oil deal is a game-changer in the global energy market. This agreement allows Canada to access the world's largest energy consumer. Canada is investing in pipeline infrastructure to connect its oil-rich provinces to coasts. This move enables Canada to ship oil to new markets in Asia and Europe, reducing its reliance on the US. Mexico, America's southern neighbor and a vital part of the North American Free Trade Agreement, or NAFTA, has also felt the sting of Trump's tariffs. Like Canada, Mexico has responded by diversifying its trade relationships and seeking out new markets. This strategy involves strengthening ties with existing trading partners and forging new alliances, particularly in Asia. Mexico has been actively working to reduce its dependence on the United States market, which currently absorbs around 80% of its exports. One of Mexico's key moves has been to strengthen its trade relationship with the European Union. The modernized EU-Mexico trade agreement, which came into force in 2020, has eliminated many trade barriers, opening up new opportunities for Mexican businesses. Furthermore, Mexico has been actively courting Asian markets, particularly China. The two countries have seen a significant increase in bilateral trade in recent years, with China becoming a major importer of Mexican goods, including agricultural products and manufactured goods. Mexico's strategic pivot away from the United States demonstrates the unintended consequences of Trump's tariff plan, as it has pushed key allies into the arms of other global powers. For decades, the North American Free Trade Agreement, or NAFTA, and its successor, the United States-Mexico-Canada Agreement, or USMCA, have been the cornerstones of economic integration in North America. These agreements facilitated the seamless flow of goods and services across borders, creating a highly integrated and efficient regional economy. However, Trump's tariff plan has thrown this carefully calibrated system into disarray. The tariffs have disrupted established supply chains, increased costs for businesses, and created uncertainty in the market. American manufacturers, once the intended beneficiaries of the tariffs, have found themselves grappling with higher input costs as tariffs on steel, aluminum, and other raw materials have driven up prices. These increased costs have been passed on to consumers in the form of higher prices for everything from cars to washing machines. Moreover, the tariffs have created a chilling effect on investment, both domestic and foreign. The uncertainty surrounding trade policy has made businesses hesitant to make long-term investment decisions, potentially hindering economic growth in the long run. As Canada and Mexico forge new trade relationships, the United States risks becoming increasingly isolated, undermining its economic and geopolitical influence in the region. Section 5. Market Jitters. Global Reactions to the Liberation Day Tariffs. The announcement of the Liberation Day tariffs sent shockwaves through global markets. Investors, already wary of rising trade tensions, reacted swiftly, triggering a sell-off in stock markets worldwide. The Dow Jones Industrial Average, a key indicator of U.S. market health, experienced its sharpest drop since the 2008 financial crisis. The technology sector, heavily reliant on global supply chains, was particularly hard hit. Apple, a tech giant that manufactures many of its products in China, saw its stock price plummet, wiping out billions of dollars in market value. Other major tech companies like Google, Amazon, and Microsoft also suffered significant losses. The tariffs have also contributed to volatility in other sectors, including agriculture, manufacturing, and energy. The uncertainty surrounding trade policy has made it difficult for businesses to plan for the future, leading to reduced investment and slower economic growth. The International Monetary Fund, or IMF, has warned that the tariffs could shave off as much as 0.5% of global GDP growth, highlighting the far-reaching consequences of protectionist trade policies. Section 6. From Silicon Valley to Detroit, U.S. industries grapple with the fallout. The impact of Trump's tariffs has been felt across a wide range of U.S. industries. While some sectors, like steel and aluminum, initially experienced a boost from the tariffs, these gains have been offset by losses in other areas. The tariffs have created winners and losers in the American economy, but the overall impact has been negative. Manufacturers, particularly those in the auto industry, have been among the hardest hit. The tariffs on steel and aluminum have increased input costs for car makers, forcing them to raise prices and cut production. This, in turn, has led to job losses in the manufacturing sector, undermining one of the stated goals of the tariffs. The agricultural sector has also been negatively impacted by the tariffs. China, once a major importer of American soybeans, pork, and other agricultural products, retaliated against U.S. tariffs by imposing its own tariffs on American goods. This trade war has cost American farmers billions of dollars in lost revenue and forced many to file for bankruptcy. Section 7. The political backlash, tariff troubles for Trump. The economic fallout from the tariffs has not gone unnoticed by the American public. As the costs of the trade war have become increasingly apparent, so too has the political backlash. Voters, feeling the pinch of higher prices and economic uncertainty, have begun to question the wisdom of Trump's trade policies. The tariffs have become a political liability for the Republican Party, which has traditionally championed free trade. In the 2018 midterm elections, Democrats campaigned heavily on the issue of tariffs, arguing that they were hurting American workers and farmers. The Democrats' message resonated with voters, particularly in rural areas that had been hit hard by the trade war. The political backlash against the tariffs has put pressure on the Biden administration to find a way to resolve the trade dispute with China. However, undoing the damage caused by the tariffs will be a complex and challenging task. The tariffs have created a climate of mistrust and uncertainty that will be difficult to overcome. Section 8. A New World Order. The rise of alternative trade blocs. Trump's tariff plan has had a profound impact on the global trading system. The tariffs have accelerated the trend towards regionalization, as countries seek to reduce their reliance on the U.S. market and forge new trade relationships. This has led to the emergence of alternative trade blocs, challenging the dominance of the U.S.-led global trading order. The Comprehensive and Progressive Agreement for Trans-Pacific Partnership, or CPTPP, a free trade agreement between 11 countries in the Asia-Pacific region, is one such example. The CPTPP, which came into effect in December 2018, lowers tariffs and reduces trade barriers between member countries, creating a significant trading bloc that excludes the U.S. Similarly, the Regional Comprehensive Economic Partnership, or RCEP, a free trade agreement between 15 Asia-Pacific nations, including China, Japan, and South Korea, is another example of the shifting geopolitical landscape. The RCEP, signed in November 2020, creates the world's largest trading bloc, accounting for roughly 30% of global GDP. These alternative trade blocs represent a challenge to U.S. economic and geopolitical influence, as they offer countries alternative markets and reduce their reliance on the U.S. Section 9. Conclusion. A tariff tempest in a teacup? Trump's tariff plan, launched with the intention of revitalizing American manufacturing and bringing back jobs, has instead backfired, creating a cascade of unintended consequences that continue to reshape the global trading system. Instead of achieving its stated goals, the tariffs have disrupted global supply chains, increased costs for businesses and consumers, and driven a wedge between the U.S. and its closest trading partners. While the full impact of the tariffs is still unfolding, it is clear that they have failed to achieve their intended objectives. Instead of strengthening the American economy, the tariffs have sown uncertainty, fueled a political backlash, and accelerated the trend towards regionalization. The long-term consequences of Trump's trade policies remain to be seen, but one thing is certain: the global trading system has been irrevocably altered. The rise of alternative trade blocs and the strengthening of ties between countries like Canada, Mexico, and China demonstrate the limits of protectionist policies in an increasingly interconnected world. As the global economy navigates the fallout from Trump's trade war, one thing is clear: the era of unchallenged U.S. economic dominance is over.